Hi, everyone. It's Helen from SME Deal Hunter. Today we have Ryder Fyrwald with us, an entrepreneur who bought two label manufacturing businesses over the last 5 years and also a reader of the newsletter. I know I'm very excited to hear Ryder's story today. Ryder, it's great to have you.
Hi, Helen. Thanks so much. I'm really excited to be on the program here with you.
Well, look, let's get started. What's your background and, what were you doing before being an acquisition entrepreneur?
Yeah, so I spent about 7 years in a couple of different professional capacities. I spent the majority of it, about 5 years, working for a couple of venture-backed tech startups, mostly in New York City, and got to experience, high growth tech environment, fast paced. It's kind of venture-backed, similar to what you've done in your experience. And through that time, learned a lot about starting a business, learned some things that I was interested in, some things that I, didn't really want. Like the venture capital world can be, intense and high growth, kind of like you've said to me in the past. Spent another 2 years after that in real estate, private equity. So did a handful of deals around multifamily and, a couple of different financing deals in that world, and then hit this point about 7 years into my career where I wanted to go into business for myself. Didn't really have a business that I wanted to start, but I knew I wanted to be on my own. So I started looking into this world of entrepreneurship through acquisition. I read a couple of books, listened to some podcasts, talked to some people who had done search funds on their own or who had gone and bought businesses just through debt or personal financing, and really fell in love with this idea of buying a business. And, particularly looking at slightly more antiquated businesses that had maybe been run by my parents' generation that could benefit from fresh, youth being injected into the business, some new ideas, maybe modern technology, things like that. And so I started looking about 6 years ago in Southern California for B2B businesses, primarily in the manufacturing, packaging space was an area that I really got interested in as I was doing this, and partnered up with one of my closest friends from college, a guy by the name of Pat Wafer. And we ended up spending about 6 months looking at 300 to 400 different companies, cold calling these businesses, looking at all the different websites, the bid, buy, sells, deal stream, all those different things. And we found a small label manufacturing business in North LA. We ended up buying the business and buying the warehouse along with it. And it was called Alros Label at the time. We've grown the business about 20% compounded year over year since we started. And this year, we actually just acquired our second business. 3 years ago, we rebranded it from Alros Label over to Cover Label. And then we just acquired another company called Crown Label and have merged it into our existing operation.
Very exciting. I'm curious, going back to the search, you mentioned you guys spent 6 months looking at 300 to 400 companies. Were you mostly, did you do any off-market outreach? Like where did you see the most success? Were you putting out a bunch of LOIs at that point? Or was this sort of like the first serious deal you guys pursued?
We submitted a bunch of LOIs. So we had several deals that we ran a process on. We didn't have a ton of experience with this. This was our first deal. So we kind of wanted to buy one that had been vetted. So we didn't really go after any off-market deals so much. We more focused on, biz ben, biz buy sell, deal stream. There's a whole slew of them that I'm sure your readers know about through your newsletter. And that's where we looked. So what we started with was kind of, all right, what types of businesses do we want to be in? And to do that, we looked at, okay, what do we not want to be in? We knew we didn't want to be in restaurants. We didn't want to be in retail. Direct to consumer wasn't really either of our backgrounds. So we knew, okay, B2B was really our area of focus. And through that, we started zeroing in on what types of companies we wanted to look at. We knew how much funding we had access to. We did this all our own capital and debt, a lot of debt through this process, because we wanted to be the owners of the business. To this day, we still 50-50 partners. We don't have any equity investors. And that was big for us. Just both having been in venture-backed businesses, we know what that leads to. Yeah, we spent a bunch of time doing that. We talked to brokers. Through that, we started getting introduced to, accountants, attorneys, anybody who's involved in selling a business, we were talking to and we were reaching out to.
Got it. And it took you 6 months to find that deal and longer to close, or did you close that deal within that 6 month period?
We actually closed it. So we spent
Wow.
in about 3 months, we found the business and closed in about 6 months. In, I think, a lot of ways, we were at a point where we both kind of needed to find a business. We couldn't exactly be taking, a year or 2 years to go and do this. In a lot of ways, I think ignorance was bliss a little bit. We didn't know what we didn't know at that point. I think if I could go back and do it at this point, I probably would have pushed on a lot of things that maybe made them walk away. But we were willing to make certain sacrifices because we needed to get started on this. And it's worked out. We've been fortunate to have it be a good business that we ended up buying. But yeah, it took us about 3 months to find it, 3 months to close.
Got it. And were you guys both, I'm guessing, not working full-time jobs at this point and doing this full-time, or what was the time commitment like on your end?
It was full time. So we both quit our jobs and this was our job. We treated it like a sales process. We would sit in, my business partner's house and we would research businesses and we would alternate cold calling and building profiles. And I think one thing that really helped us was we built a profile pretty early on. So a lot of times when you're going and talking to these people who are selling businesses, they want to see a buyer profile, they want to see resumes, they want to see your credit scores, personal financial statements. We realized that early on. So we put that together and we had a really nice package and we had a cover letter that we would send out once we started going down this process. So we were 100% focused on this. This was our job.
No, that's great. And I'm sure having a partner was helpful. It can be such a lonely process from, folks I speak to that are doing this alone.
Absolutely. I don't know. I don't know if I could have done it without a business partner.
Yeah, no, definitely. And having a package is, great advice. I think, a lot of people don't do that and definitely, puts you above the rest. So that's great. I guess what was your goal, going into this? Was it buy one business, buy multiple businesses, like buy one and flip it? What'd you go in sort of thinking you were gonna do?
Our goal was to buy multiple businesses. And initially the thought was actually to not necessarily buy businesses that were in the same umbrella. So we were thinking we could have a holding company with multiple different types of businesses. I think once you get into the business, if you're really operating it, you realize how much time it actually takes to do it. So for the last 5 or 6 years, this has been my life. But our initial goal was to buy multiple businesses within the same, of different types of businesses, build a holding company. That's shifted since then, but that was our initial business plan and goal.
Got it. Got it. And I guess what did you like about the label manufacturing opportunity and kind of how did you end there? How did you end up there?
So there were a couple of things about it. I think the two biggest things were, one, you realize it more so now than at the time, but labels are everywhere. If you
Yeah.
look at anything from cosmetics to food products to manufacturing products, anything you can think of, this picture frame behind me, this water bottle, it all comes with some sort of label on it. That was one. And then two, it's a recurring revenue business. So all our customers are buying monthly, quarterly, yearly. They're constantly buying, creating new packaging. And so we had both come from software businesses where, recurring revenue is kind of all of what you talk about. It's what is your annual recurring revenue.
Yeah.
So having like the recurring revenue component of it, that was really intriguing for us.
No, that's super interesting. And how did you guys finance the deal?
We did we did three components. We put a little bit of our own capital into it, some seller financing, and then the majority of it was debt financing. We didn't actually go through the SBA. In hindsight, we now have done some SBA financing since then on different machinery and things. That's probably the route that I would go. But we were able to find like private money lending. Mhm.
And why would you go SBA versus sort of like finding private credit options now?
Well, I think that now that we're at a point where our business is big enough, I feel like we can really get the approvals on the financing from the SBA. They're going to give you the best rates by far. Is just what I've seen, is that the SBA has the ability to give you really attractive financing. Obviously with the interest rate environment today, it's a lot different than it was 5 or 6 years ago when we were buying a business. But we just have found that that's the best rates. They're willing to give you really long-term financing. So that, I think, is the best option. What was fortunate for us is we were able to finance this through kind of like some of our network. And so we've been good about paying down the debt, but if we were to ever, miss a payment, have a couple of months where we weren't able to, meet our payments, they're not going to take the business from us. So that was really helpful early on. We've been able to kind of keep up for the most part, but the SBA, just because of the length of the loan that they're willing to give you, as well as the rates, that makes it really attractive.
Definitely. I'm curious with the opportunity itself, did you, see a lot of room for growth there? Obviously everyone loves recurring revenue, so that's awesome. But what else did you like about the business?
It was really well run, for one. So it wasn't, when you start to look at a lot of these businesses, you start to get into these, seller discretionary earnings numbers, right? So when you think about a business, you think about EBITDA, you think about, earnings or revenue. But when you look at small businesses, they're going to give you this seller discretionary earnings number, which is basically like the EBITDA plus whatever the owner was paying themselves, plus whatever else they were running through the business, car
Yeah.
payment, insurance, whatever else these things are. So this business didn't have a lot of those things in it. So we wouldn't have to really sift through what was real and what wasn't. And for us as first-time business buyers, that was really important to just know what we were buying and realize, hope that there weren't very many skeletons in the closet, which there have not been. So it was a well-run business. The owner of the business had told all the employees what he was doing. He was retiring. He had owned the business from the start. The broker involved in selling the business was super transparent and worked with us and really taught us about buying the business. So it was a lot of the components around the business in addition to the business itself. We felt like there was an opportunity to grow the business for sure. We've seen the label landscape. I think we underestimated, honestly, how much potential there was in this industry. We thought we could grow it, but I really didn't have any idea how big the space was until we got into it.
I know I'm super eager to learn more about the label industry. What is, what do you believe is sort of like this underrated opportunity? I'm curious to learn more.
Yeah, so I think with labels, it's just for, like I mentioned before, for one, they're everywhere. We don't have to hold a ton of inventory here. We have inventory, but it turns over pretty quickly. So we can be super adaptive as new materials come to market. Sustainable materials will start to permeate the market, hopefully in the next, 5 to 10 years. It's been slower to adapt, I think, than I would like, than I think people would like, but eventually it will. So I think just the fact that they're everywhere, that we really don't have to limit ourselves to one particular industry. When we bought the business, it was very cosmetics heavy. Now we've been able to really broaden the scope of the types of customers that we work with. So we have a ton of cosmetics, we have a lot of food and beverage. So when I'm talking about it, I usually tell people, like, whatever you see in your fridge or your medicine cabinet, those are the types of things that we make. But it doesn't stop there. It's things in your shower, it's things in your car, it's things in everyday life that you see, whether it's batteries or computers, whatever it is. It's the furniture, picture frames. They're just everywhere. So for us, it's been, that's been great, because anywhere we go, I can kind of walk into any type of store and pick up a product. And see the label and there's a prospect, right? On top of that, it's a very fragmented industry. There are a lot of, $1, $2, $3 million businesses especially in and around like major cities, around LA, there's a couple of hundred label manufacturers. A lot of them are people that have been running these businesses for years. They've got a very steady customer base. They're maybe doing, $1 million, $2 million in revenue. They're making $250,000, $500,000 a year, and they just have a really good steady business. And so we see that as a big opportunity for us. Now that we're a little bit bigger, we can also look at going and acquiring more of those businesses. There is opportunity to acquire customers as well. And a lot of times once these customers are with you, they tend to stay with you for a couple of years. It's fairly sticky. It's not a forever thing, especially if companies grow really fast. They might outgrow you, or something changes, they get acquired. That might happen. Yeah, I think for all those reasons, it's been a great industry for us, and I think it's attractive still for quite a long time. I don't think they're going anywhere.
No, that's super interesting. You mentioned, there are a couple hundred label manufacturers in LA alone. How do you guys differentiate yourselves, or how do you think about differentiation?
So there's a couple of things. One, we offer the types of label printing that we offer. We can do small ordering all the way up to super large scale stuff. So we have implemented digital printing capabilities, and we also have it's called flexographic printing, which is kind of the old school, more traditional way of doing it. So if you're just starting out, we can help you as you grow, and hopefully the business takes off. We can still stay with you. So that's one, is just offering a lot of different capabilities. Two, we've realized that the turnaround, the lead time, super critical. If we can turn things around in 5 to 7 business days, we tend to be a lot faster than our competitors, especially the bigger guys. So somebody can't always wait 3, 4 weeks for something. They need something quicker than that. That's kind of where we step in, do a good job, and then they stay with us. And then I think the most important thing for us is just really good customer service. People are buying something that they might consider to be a commodity. They're maybe not used to somebody responding quickly, holding their hand, maybe teaching them about the labels. If something goes wrong, which inevitably it will, we're printing hundreds of thousands of labels a day, sometimes millions a week, like you're going to have issues, and just resolving those issues quickly, being responsive, and offering really good service. So I think those are the 3 areas that we differentiate ourselves.
That makes a lot of sense. I guess jumping here a little bit, you mentioned you bought the business with real estate. What made you guys decide to do that? How do you recommend structuring those types of deals? I get asked that a lot. So I'm curious how you guys did it.
Sure. So I had a bit of experience in real estate, so that was always important to me. I talked to a lot of small business owners, and I would talk to them, and they'd say, look, I own this business for 30 years. And the most valuable thing at the end of it was like the real estate was worth as much, if not more, than the business. When we bought our business, we bought the real estate from the same gentleman who owned the real estate and the business. And we paid a little bit more for the real estate than we did for the business. And he was able to, over time, pay for the real estate through the business, which is what we do now. We ended up actually selling that building and moving into a bigger facility because we outgrew it. And by having, people call it like the opco, propco, right? So we have our operating company, which is our label printing business. And then we have our propco, which is our property company, which is our building. We keep them as they're 2 separate entities. My partner and I own them 50-50 each. And we pay rent from the operating company into the property company. There are a lot of really attractive things about owning a building, depreciation. We did a cost segregation study, which allowed us to accelerate the depreciation on the building, which is depreciation, that we can take against our income from the operating company. If we're ever having a tough month and I need to pay rent a week or 2 late, I'm paying it to myself, so I don't have a landlord breathing down my neck. the way that you asked about the structure, the way that we did it is we have them as two completely separate entities. They're both different LLCs, and the ownership structure is the same. We're both 50-50, but they are completely separate companies. I think one of the interesting things that I learned about kind of after we bought the business was that the SBA will finance, I think, like 80 to 90% of the combined value. So if you did buy the business and the real estate together, the SBA will offer you a pretty nice package to finance that whole thing. We didn't really know about that at the time. We ended up doing it separately. We actually had an investor buy the building originally. For the most part, we were also part owners in it, but we brought in an investor for the building. And I think a lot of investors are really attracted to real estate investments. So there are a lot of different ways you can structure it. You can bring in an investor, you can go to the SBA. There are a lot of different financing options when it comes to having both. And then for this new building, what's been great is we got a really, really attractive interest rate because we operate a business out of here. So there's like an owner operator option that a lot of banks or the SBA will have, where they'll give you really attractive financing as long as you operate at least 51% of a business out of a building. So we ended up buying a much bigger building than we thought we could afford, because we only operated out of about 51% of the building when we bought it, and we leased out the rest. We've grown into that space, which I think was a good move for us. So now we occupy most of the building. But yeah, those are kind of bounced around there, but those are some of my thoughts on that.
No, that's great insight, and thanks for sharing. I'm curious with the first deal, how did you guys do diligence on the business? I'm assuming not coming from the labeled manufacturing world.
So we both had business backgrounds where we were able to do our own diligence, and we had some mentors and things that we were able to go to. But really, it was just do it on our own, research. We researched the industry. We went out and one thing we did that I think was helpful is we went out and kind of like shadow looked for competitive pricing. So we went around to a couple of other label manufacturers to try to see like where their pricing was relative to the one that we were buying. So we knew we weren't, really high or really low compared to the competition. We found as much like data that was out there as possible. We talked to like other people who had bought businesses about the things to look out for, whether it's, hey, are you buying the accounts receivable? Are you buying the accounts payable? And if so, how does that work? Are you buying the inventory? And if so, how do you value the inventory? And just breaking it down into all the different subcomponents of a business. There's a lot of great resources online, your newsletter, or if I was buying a business now, that's something that I would be reading for sure, is just what are the different components to look for. There's probably 15 or 20 documents that you end up having to sign. So it's, buyer disclosures, seller disclosures, all these things that until you get into it, you don't really know what they are. So just leaning on resources, whether it's just your own research or if you can find people that are experts on those things, really going and trying to understand them to the best of your ability.
That's great advice. I'm curious, how did you end up structuring the deal? You mentioned, buying the AR and AP, buying the inventory. How did you structure all of that?
So we did it. Our original business that we bought, we learned a lot of that things that we actually did differently on our second one. So we did buy the accounts receivable. That happened to be the number happened to line up actually very closely with the amount that the seller was financing. So the seller financed about 10% of the business. The accounts receivable that they had at close were almost exactly that amount. So we actually securitized the receivables against the seller carry note. So if at the end of trying to collect those amounts, if there was anything left, which there was a very small balance, we were able to basically take that against the seller carry note and reduce the note by whatever we weren't able to collect. I would not advise buying the receivables if I was buying a new business, because what you don't want to do is get in there and buy a business, and then the first thing that you do with all these customers is call them and ask them for money, right? So to the extent that the seller is willing to, I would leave the receivables with the seller, leave the payables with the seller. It allows you to kind of start clean. We did an asset purchase. So there's the asset purchase is basically you start a whole new entity. The history from the previous business stays with that entity, and you basically just take over all of the, for us, it was all the machinery, the customer list, and then all the other stuff that came along with it, whether it's racks, tooling, all these different things. But originally we did buy the receivables, we did take over the payables. So we had to deal with that. It was a good learning experience, but not something I would necessarily do again. And then the inventory in our business, the size of the business that we were buying was small enough to where the inventory was kind of negligible. It was 10 or 15 grand total, which was hard to really value exactly what that would have been. So we actually just had that as part of the acquisition. We didn't actually put a value on the inventory. I think for a smaller business, that's okay. And for our business, it was fine because we turn the inventory over every 30 days. Other businesses, that might not be as applicable, but for ours, it was fine.
No, that's super interesting. I guess, can you tell me more about the second or most recent acquisition? What did you guys do differently? What did you like about the opportunity? Now that obviously you're already experienced in the space, what did you do differently this time around?
For the most recent acquisition we did, which was in January, we started about a year ago. We were at this point where we were thinking, hey, we either need to put another tenant in our building, or we need to fill that space with something that, we operate. And so we said, well, we already bought a business. Let's just buy another one that fits into kind of what we're doing. So I started looking around like other businesses for sale. I kind of popped back on the websites. And then one day I was having a conversation with one of my suppliers, and he said something that stuck out to me, which was, he said, I've got this other business owner that I'm going down there, and this guy just wants to sell his business. He can't get out of it soon enough. And that kind of clicked for me with having realized that all of our vendors are at our competitors all the time. So I just went to all my suppliers, went to like 5 or 10 of my suppliers, and I said, hey, you guys are in these businesses every day. Do you have any business owners that you know of that might be looking to sell? Because business owners, they kind of tend to be pretty open with their suppliers. The supplier comes in there and they'll tell them something, hey, cash flow is tight, or I've been doing this for 30 years, I'm sick of it. And I got like 10 leads from my suppliers of different companies that were not for sale on the market, but owners that might be looking to sell. So I started calling these owners up and I said, hey, I know this is kind of out of the blue, but I own a label manufacturing business. We bought it from another, a gentleman kind of like you, or a woman kind of like you that was in business and was looking to get out of it. And I think this can be a really nice exit and retirement plan for you. And I met this owner about a year before we bought it, and we started working together. He started outsourcing some projects to us. We kind of just started engaging. I ended up going down there, meeting him, having lunch, just getting to know each other a little bit better. And eventually he became comfortable enough with us to where he said, hey, look, I'm ready to retire. I'm like kind of overdoing this, and I'd like to get out. So we ended up structuring a really great deal. I think it's great for both sides. It was 30%. We put down 30%, the rest is financed. So he got a nice chunk of money to step away, and now he gets a check in the mail every month with interest on top of it. So 70% seller financing. And I think some of the things we did differently on this one were we didn't take over the AR, the accounts payable. All that had to be taken care of by him. He collected from his customers. He took the payables, paid those down. That was, I think, a much cleaner transition. We took all the inventory, which was not that much. He was able to kind of deplete his inventory out. And because we have a lot of the same suppliers, we just went to the suppliers and said, hey, this business, we're now taking over the company. All those materials that we were selling to him, they're already selling them to us. So we were able to kind of seamlessly take that on. All the other functions, the finance, the HR, all those things, we put them under our umbrella. So we're able to save on a lot of those costs. And then the machinery, we ended up moving all the machinery into our warehouse. So we operated out of his place for about 2 weeks, and then we moved everything up into our facility.
Got it. Yeah, that's super interesting, and I guess very a genius way to get deal flow that not enough people talk about, going to your suppliers and vendors and seeing if any of the other clients want to sell. That makes a ton of sense. That's awesome. I guess with the first acquisition and even the second one, what did the transition look like? How long did the seller stay on for? What was it like for you guys, going into this kind of like completely new world and learning the business and then eventually, growing it?
So the first one, they stayed on for about 2 months total. We thought we were going to need them for a lot longer. So one thing we did was we structured a consulting agreement post-close that was basically like, we get 1 month of just your time as part of buying the business. You have to continue to come in. You've got to teach us, transition the business. They had a general manager and the owner, both of whom were coming in for about a month after we closed. We spent a ton of time just learning from them, whatever we could. And then pretty quickly, we realized that a lot of the like unique things about the business were actually in the operators of the machinery, and the stuff that the owner and the general manager were doing were really just business functions, right? They were just talking to customers and they were working with vendors, and you're trying to make sure that the business is profitable. We went to all of our suppliers. This was actually one thing that was really helpful. We went to all of our suppliers and we said, hey, we just bought this business. We need you to come in and basically explain to us what you do. And so we kind of put it on all of our suppliers, who for them, they're selling you something, right? So they need to come in anyway and meet you. So we said, come in, basically give us whatever you can, whatever type of training you can on whatever it is that you sell. And we were really fortunate where we had several suppliers come in and spend like an hour or more with us, teaching us about the industry. I remember one of our vendors came in and he had a full presentation prepared of like label manufacturing and went A to Z and just kind of taught us the whole business. So we were very fortunate to find that, and we really leveraged our suppliers to learn as much as we could about the business. We realized pretty quickly that we didn't really need the old owners around, nor did we really want them around. They've been helpful, and the original owner, I don't talk to him anymore. It's been so long, but the business that we just bought, I still talk to him if I have a question about a customer or something. They were pretty organized in terms of their documentation, so I don't really feel like I need to. The most recent one, because we have a ton of experience, I only had about 2 weeks with him where I really needed stuff from him, and we were able to transition it. But I think trying to get 6 months, get them to commit to that, you'll realize, depending on the complexity of the business, that you probably don't need that much time. As soon as you're comfortable, right, try to separate, as much as you can. We still have a seller carry note with the previous owner, so I'll still be with the owner of the business we just bought. So I'm still in touch with him pretty regularly. But I think that plus the suppliers to us were probably one of the best ways that we were able to learn as much as we could about it early on.
No, that's super smart. And I, haven't spoken to anyone else who's just brought their suppliers in to teach them about the business, but that makes a ton of sense. It's really, really smart. I guess I'm curious though, especially with the first business and, business plus just the entire process, anything unexpected, both, about the business itself, once you transition, the, acquisition process, or just, in general, the whole business buying process, was it everything you kind of expected? Curious to hear your thoughts on that.
It definitely wasn't everything I expected, both, in a lot of ways, in positive ways, in some ways, negatives as well, for sure. So I think one of the challenges is that it always takes a lot longer and, costs more money than you might think. Our business is very capital intensive, so we've had to make several large investments into machinery over the last 5 years in order for us to be able to grow. And if you want to continue to grow, you have to make pretty heavy capital investments. So really understanding the industry that you're getting into and what sort of capital investments that you might have to make. That was, I think it wasn't a surprise to us because we knew that, but just how dramatic it can be if you really want to grow, was something that we kind of had to go through and really learn. I think that's my train of thought, but yeah, I mean, I think there are some other things there with, with buying a business. You are taking over all these customers who have had relationships with the previous owner. So trying to understand the relationship that they had with the previous owner is helpful. If it was, for example, if it was they were best friends and that was the only reason they were doing business together, that's something you need to know to the extent that you can before buying the business. We had something that we haven't really spoken about, but customer concentration, which I know comes up a lot in small businesses. There was some customer concentration with the first business that we bought, as well as the second business. I think with these smaller businesses in the label manufacturing space, you do tend to have some concentration because you might have one or two big customers that are responsible for, 20-30% of the business, whatever it might be, which we knew. But what we didn't really know on the first one was not just how much of the revenue that customer was doing, but also how much of the profit. So we did try to go and compare pricing against other companies. But what we found out when we bought the business was that there were two customers doing about 30% of the revenue, but they were probably responsible for more like 40 or 50% of the profit because these were very profitable customers. And so we were able to keep them and we were able to build great relationships. And we still have one of them got acquired and ended up shutting the business down, but that was after several years of owning the business. And then the other one we still have to this day. So I think understanding not just how much revenue they're bringing in, but also how much of the profit. And then for the business that we just bought, one of their big customers is a publicly traded like medical device company, and they required a pretty serious audit on us. They had to come in and do like a full day audit of all of our quality control processes and everything from, do you have your management meeting notes documented, to what do your training programs look like? And we had a lot of that stuff in place. But we had to work for about 2 weeks to kind of get the whole place ready for them to show up. We went through the audit, it went fine. We passed and everything, but knowing like the customers are the most important thing about the success of this purchase, right? That's where all the revenue is going to come from in the first couple of months. So really understanding who are the customers, what's the relationship with the owner, what's the revenue and the profit that those were doing. I think that's probably the most critical thing.
And how did you guys get comfortable with the customer concentration in these two deals? Did you structure the deal in any way to sort of de-risk that for yourselves, or just try to learn more, I guess, about that relationship, really?
The first one, it wasn't crazy bad, the concentration. It was significant, but it wasn't like this outlandish thing. And there were two businesses that we were able to learn a lot about. And we found out that they were both pretty big, well-run businesses that had a great, relationship with this owner and with our business. And they loved working with us, and we were giving them really reasonable pricing and lead times and all of that. So we just through our research and through talking to the owners, as well as the just the company, we were able to find out that there wasn't really any risk, that huge risk of these customers leaving. And that ended up being true. For the second acquisition, we definitely factored that into the price. So, we pushed the price down quite a bit because of that. And then the second thing we did was we backed the seller carry note. We backed that against basically against like losing this customer. So if we lose this customer anytime in the first 18 months of owning the business, we get a reduction to the seller carry note. There are certain stipulations as to what it would be. If it's something, if we screwed up an order and they are like, hey, we're canceling because we can't work with you guys because you're not a good vendor, then obviously that's on us. But if we didn't pass the audit for some reason and he wasn't transparent with us, then we would get a reduction to the seller carry note that we felt like was about equivalent to what that value was to the business. So I think, assign a value to those customers. What are they worth to the business? And try to figure out some way to protect yourself. Seller carry note, against the seller carry note is probably the best one, but some sort of way to kind of claw back if you do end up losing that customer for any reason.
No, that's really smart what you guys did. I guess I'm curious, what do your and your partner's roles look like now, day to day? You mentioned you've been working 5 or 6 years in the business. At what point did you decide you were going to go buy another business? And did you have time to even start thinking about additional acquisitions?
We early on, like I mentioned, we've got relationships with our suppliers going pretty quickly. We found this guy who was a consultant, and he worked for a number of different label companies in the area. A lot of what he was doing was training their employees, helping fix their machinery. He's mechanical, and we met him probably 4 years ago, and we told him kind of ever since we met him, like, as soon as we're big enough, we want to hire you. And so about a year and a half ago, beginning of last year, 23, he finally came to us and said, hey guys, like I'm interested. The business is big enough. And we basically had a, sit down with him and kind of verbally said, okay, we want to work together. It took us about 3 to 6 months to really structure all of that. But in July of last year, we brought on a general manager who's just been a total game changer for our business. He has a ton of experience, and he's just been, amazing to have on board. It's really taken a lot of the day-to-day responsibilities away from my partner and I. So I say that because it was at that point, once we knew he was coming on board, that's kind of when we started looking at another business to buy. And we said, we need to be a little bit bigger, I think, than we are. And we need to have a couple more machines and a couple more people in order for it to really make sense for him to come on board. So that was when we started looking at an acquisition. I also say that because it has drastically changed our roles in the company. Originally, for the first 5 years, I would say, up until he came on board, basically the split was my partner handled more of the production side. He's more mechanical. He's more kind of inclined toward learning the machinery. So he's been kind of back of the warehouse production, looking over all the machinery, learning the machines, figuring out what machines we should buy, all of that back of house production stuff, the compressor breaks, he's on that, like things like that were really where he spent the majority of the time. Inventory, he did all of our purchasing, all of that stuff. And then I focused more on finance, HR, collections, receivables, things like that. And then we split the accounts. So kind of day one of owning the business, we took the business and we split the accounts 50-50 so that we could both learn the business. And now we both have account managers that manage the customers, but we still kind of oversee about half the business each. And we each do our own like sales and business development. That's helped. We got to keep, like with any business, you have to keep bringing in new customers. And so having both of us do that has been helpful. But what we've focused on really is for the past 5 or 6 years is kind of hiring to our strengths. So we both like sales, business development. We like growing the business, whether it's acquiring a business or, selling to new customers. So it's how can we just hire people to do all the other things? First thing was hire a shipping person. Then it was, buy a digital machine, hire a digital operator, hire a graphic designer, hire account managers, and now it's been a general manager. So it's really just how do we kind of have other people do the things that we're not maybe as good at or that we don't want to spend our time on, so we can focus on how do we grow the business.
That's no, that's really smart. I'm curious, and I'm sure a lot of people are too, what was the process like for you to hire this and vet this GM that eventually came on? And also, how do you think about compensating this GM or this person to keep them sort of motivated to help grow the business with you?
We were fortunate to have met this guy years ago, so we knew his work ethic. That was the one thing I knew. There were two things about him that I knew. I knew his work ethic, and I knew his attitude, and I knew that he had, of course, all the capabilities. He would come in, he would fix our machines. We'd have a really complicated job. I'd call him up, hey, can you come help us run this, or can you come in on the weekend? We hired some new people. He came in and helped train them. So I got to really see firsthand his experience and how much he knew about this industry. So we kind of got this he was a vendor of ours, but we got this relationship with him over time. And then every time he would come in, he'd be so positive and so happy and so like excited to be there. And he's, he's got a print for you license plate, and he's just, labels are his thing.
Love that.
We had to be big enough though. He was working at he had a bunch of other customers who was going to have to give up his own, his own business in order to do this. So we had to get to this point. Once we hit this point, I kind of went to him and said, hey, look, I think we're ready to bring you on board. And we spent a lot of time negotiating. So the compensation piece was tricky because we couldn't really pay him the salary that I think he probably is worth or deserves. But he had just gone through this experience where he had been spending a lot of time working at this one company, and the company got acquired, and he didn't have any equity. So he didn't get to participate in that liquidation event. So what we've done with him is we brought him on, and we have several different compensation components. One is the salary. Two is there are some expenses involved. So, car, things like that. Three is commission. So if he brings in new business, which he has done a lot of, he gets commission on that. And then probably the most important component is we've given him equity. So we've structured it where there are different components to that, but there's equity that vests over a certain period of time if he just stays with us and we keep him on board and the business continues to operate. There's equity if we hit certain milestones with the business. If we hit certain revenue targets, he gets equity that kicks in for those. And then the third component is he has the ability to buy in. So he could buy in for at certain points as well. If we hit certain targets, that triggers both equity for him as well as the ability to buy additional equity, which would give my partner and I an option to take some chips off the table.
Got it. That's really smart. Thanks for sharing. I'm curious now, what is your role like now, since bringing him on? Are you still sort of splitting the biz dev with your partner? You really, step back from that and now focusing on additional acquisitions? What does that look like?
The main thing that I do at this point is really biz dev. So I'm out trying to grow the business through sales, looking at acquisitions. I think we'll probably put a pause on any new machinery or business acquisitions for, at least a year, I think, before we really look at that. We're in a place where we've finally grown into this building we're in. We finally have all the pieces in place to really grow the revenue and the profit of the business. We've also taken on so much risk and just growth through buying machines and everything for the last 5 years that I'm just ready to kind of not take on more of that right now. And then my other focus is really just on, making sure that the business is profitable. So a big challenge, I would say probably the biggest challenge in our business is making sure that people pay on time, and collections is, a huge challenge. It's a huge pain for me to deal with. But the best person to deal with that is the person who it's most important to. So sales and profit are my main goals. So I'm looking at what are our revenue numbers every month? How can we increase that? What is our profit? Where can we be, trimming in certain areas? And then, how do we make sure that we're continuing to get paid for the work that we do? And then the last piece would be just the personnel side. A lot of my time is spent dealing with the people, and I would say 50% of my job is, working with my GM on, hey, who's performing, who's, maybe underperforming. Do we need to have conversations with people? Do we need to be hiring? A lot of the last 5 years has been about hiring. So it's been finding the right people, interviewing them, bringing them on board, helping them get ramped up. So those are kind of the three main areas of focus for me at this point.
I'm curious on the collection side, have you found any strategies to kind of help you guys accelerate collecting payment on time, or yeah.
Consistency is probably the best one. Just be on it every day, every week, follow up with people. The other lever that I don't love pulling, but it kind of is the best one and it works, is a lot of our customers are recurring. They order frequently. So if somebody has a past due invoice and they've got a pending order, then we'll just say, hey, we can't release this order until you pay. And it's a leverage thing that, again, doesn't always feel great doing it. I've been on both sides. I have vendors all the time that'll tell me if we have a past due invoice, say we can't ship your order. And it's not like I'm sitting there like, hey, you're a terrible vendor. It's like, okay, I ordered that. I need to pay for it. So people get it. It's not always the most fun conversation, but I would say using that as leverage. If they have another order coming in, it's like, hey, look, we can't ship this order until you pay for this past one. And people get that. And then just being consistent. I hired a bookkeeper actually recently we've always had a bookkeeper, but I brought one that's more consistent. And she's got a little bit of a softer approach as well. So I'll be just understanding my own flaws. I can come out sometimes when it comes to collections, I'm like, you owe us this money, please pay us. So having somebody there that can kind of play the good cop, bad cop, she'll send the reminders, the statements, and work on collections. And then if somebody needs to have a little bit more of a stern conversation, then I can kind of take that on. But it's a challenge. I mean, it's probably the hardest part of our business, to be honest with you. It's really tricky. And we've had instances of companies going bankrupt or going out of business or getting sold or whatever it might be, someone disappearing, and then we sell to individual people, and that person, the business doesn't work out and they disappear. And it's, it's definitely I'd say the Achilles heel of being in a manufacturing, the supply chain.
No, it's really interesting insight. I know, we're a little bit past time, so I want to be sensitive of that, but anything you're going to do differently next time around on the next acquisition?
Being that we already own a business, I'm in a fortunate position where I don't need to buy another business. So being really just careful about the types of businesses that we look at acquiring. We're again, like I mentioned, we're fortunate to already have a good business, and I don't want to risk that. So the business that we just bought, we got a really good deal on it. I spent a year doing the due diligence. I knew what we were getting ourselves into. It wasn't like when we bought the original business where I needed to get into something. So being patient, making sure that the business that we're buying is good and we're kind of being sold the right bill of goods, and being patient with those. I think that's, where I'm at this point, that's what I would do. If I was starting over from scratch, I would really be careful to make sure it's a business that I wanted to be in for at least the next 5 years, because there's a pretty good chance that you're going to be in it for at least 5 and most likely longer. So make sure it's something that you're excited about and that you want to stick with, and realize that it's going to be super challenging at times. It's going to be, you're going to wish that you could sell the business or that you could get out of it. And we're not at the finish line by any means. We're still in the first, I think, half of what we're doing here. And so there's still a lot more to go, a lot more to do, but it's been super fulfilling. And it's been, from a lifestyle perspective, I don't think I would want to do anything else. I have friends who work in finance jobs or high paying tech jobs, and yeah, they might make a little bit more money than I do, but I can tell you that they don't have a better lifestyle than I do at this point. The first 3 or 4 years, sure, it wasn't like that, but once you get over a certain threshold or over a certain hump, the lifestyle of being an entrepreneur it's stressful for sure. You wake up and you're wondering about that collections or about that sale, but it's fulfilling. You get to hire people, you get to have people here that feed their families off of what you do, and you get to work with great customers and work with a great partner. And then if you can get it to a point where it can sustain itself, then you can also have a very good lifestyle and ultimately a great financial way of going about it as well. So
No, that's definitely great advice, especially to the first time buyers out there. I guess final question, what's the best way to reach you, for folks that watch this interview and want to learn more?
sure. So our business is called Cover Label. We're in Los Angeles. My email is just Ryder, RYDER, at coverlabelsingular.com. You can reach me there anytime. LinkedIn as well. Ryder Fyrwald. My last name is really weird, so it's F like Frank, YRWALD. But contact me, email, LinkedIn, either way, or just reach us at our business.
Awesome. Ryder, thank you so much. Thank you so much for your time. Really appreciate it. And it's been great having you on.
Of course. Thank you as well, Helen.